Accounting equation and Excel. Closing entries after having entered the adjusting entries. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with that good old paper and pencil. But if you do have access to this workbook though, 5 tabs down below. Example, in essence, the answer key. Month 1, first month of operations. Month 2, second month of operations. The practice tab having pre-formatted cells, so you can practice this practice problem with less Excel formatting. And the ADJ tab, the one that we will be working in, is where we started with a blank worksheet, but are basically working within a template at this point in time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing. Remembering, we're basically building our bookkeeping system using the accounting equation as in essence our trial balance, from which we can and have constructed our major financial statement reports: balance sheet, income statement, statement of equity. So what we've done thus far is we've entered the first month of operations, then we closed it out, we entered the second month of operations, and then we imagined that we wanted to do the adjusting process, noting the adjusting process can often be thought of and constructed in the format as having 2 separate people doing the processes because they have 2 separate goals, although the one person can do both processes and still use the same system of separating them in a similar fashion as we might do for our personal bookkeeping versus our business bookkeeping, given the fact that they have different goals and objectives. The goal of the bookkeeper to do the bookkeeping as efficiently as possible, communicate with those we need to communicate with financially, customers, vendors, employees, and to automate the system as much as possible, making it as painless as possible so we can focus in on the practice of business instead of bookkeeping for the most part. That's what makes us the money. So then on the financial or adjusting side of things, we want to create the financial statement adjustments to make the financial statements as close to whatever value or accounting system we're applying, typically an accrual system and or possibly a tax system for the year end in particular if you're in the United States and need to do your income taxes, of course. Now note and remember that oftentimes I would still take the information out of an accounting software like a QuickBooks or a Xero, doing the adjusting entries in a worksheet. Not usually like this, because usually I would use debits and credits, but here it is in an accounting equation format. And then think about entering that information back into the QuickBooks system, which is basically where we are at this point in time. However, there's going to be problems with us entering it back into the QuickBooks system, as we discussed a little bit when we entered the adjusting entries, because the QuickBooks system or Xero system or whatever accounting software we are using are going to have issues like the accounts receivable being tied to subledgers that we have to be careful of, and the system not allowing us to make adjustments without selecting or doing something with those subledgers. We also had timing differences that we entered into the system to make things correct as of a specific point in time, but if we do not reverse them, we'll end up with a problem having entered them 2 times. For example, we had a system of we pulled in the accounts receivable before the cutoff because the work was done before the cutoff in a particular invoice to make the financial statements correct as of the cutoff date, in our case 2/28, February 28th, 2 month ended February 28th. But if I don't reverse it, then it will be in there twice as of the time of the original invoice. So we're going to have to go through here and figure out which of these adjustments need to be reversed, in particular if we're going to put this into the accounting system of like a QuickBooks or a Xero so we don't mess up the bookkeeper. Okay, so the next thing we want to consider is that we're going to have to do closing entries. Now, closing entries are typically done in software like a QuickBooks or a Xero, basically automatically, not typically on a monthly basis, but on a yearly basis. So every year, it'll, in essence, close out the income statement to the balance sheet account of retained earnings. But that can be a little bit confusing because the income statement is the timing statement over here. And I can run the income statement report in a database program, such as in a QuickBooks or a Xero, for any time frame I want, right? I could do it for 1 month. I could do it for 2 months. In this case, we have 2 months ended, or I could do each individual month, or I can do a comparison report, 1 month compared to the other month, taking the difference between the two, or possibly summing the two up so that I have 1 month, the other month, and the sum of the 2 months. Now, the reason that's a little bit confusing is because it messes up what our understanding is between the relationship of the income statement and the balance sheet. So these accounts in the equity section are the balance sheet accounts. So how can it be that I still will remain in balance if I change the income statement, which are the light blue numbers, but I don't change the balance sheet because they're as of a point in time? So in other words, in our case, we had 2 months ended February 28th. So the balance sheet is going to be the same in essence because those are as of a point in time. But if I run the income statement for 1 month that ends on 2/28, I'm only going to see 1 month of data, versus I can run the income statement for 2 months ended to see 2 months of data to see the performance for 2 months. How could I do that and still have a balance sheet that works, that ties out? In particular, if you're looking at a QuickBooks or a Xero, for example, they'll have the net income in the equity section of the balance sheet. Now, this is where the key is. This is where the kind of trick is. You would think that if I ran the 1 month ended 2/28 just for the month of February, that the net income that they pull into the balance sheet would be for the 1 month ended. But if they did that, they would have to adjust the equity section so that the closing process would work. So they don't typically do that. So what happens is the balance sheet, because it's a point in time, will always show the net income in the equity section for a year to date, whatever you chose as your year end, typically a calendar year end. So even if you ran an income statement for 1 month, February, the balance sheet is not going to match the net income to that 1 month income statement report. It's going to run an income statement for 2 months ended because the balance sheet is going to try to do the closing process automatically. That's what I'm trying to point out here. The balance sheet in software, or the whole software, will do the closing process automatically, in essence, typically, but it will only do it on a yearly basis. It doesn't do a monthly basis closeout. And therefore, if you wanted to run reports for a month or a quarter or something like that, you might have to do some adjustments to the reports generated by a QuickBooks because it's going to have that net income situation. All right. So to get an idea of how that whole process works, we're going to do the closing process here. So what I'm going to do for the closing process is simply take the net income that we had before. Those are called temporary accounts. Make them zero, closing them out, and putting the difference over here into the equity section. For us, in our practice problem, that will set us up for the March, meaning the month after the cutoff date, where we want to put our reversing entries in. Now, normally this would be year ended, so you'd have 12 months ended December 31st, your adjusting entries entered as of December 31st, the cutoff date, and then your reversing entries as of January of the following period, January 1st of the following period. Our cutoff date, because we only ran 2 months, is 2/28. So we ran our report for 2 months ended February 28th. We did our adjusting entries as of the cutoff date, 2/28. And now what I want to do is the reversing entries to see what the net income or the income statement would look like after we close out. And then we would start the period with the reversing entries because those are going to have a lot of timing issues related to them so that we can see how that would work. So we can imagine that if we put this back into a QuickBooks system, they would already have some transactions in the following period that would be from the adjusting process. All right, so the general idea of the closing entries is simply going to be all the temporary accounts are basically going to go to zero and close out. This is analogous to if you wanted to see how far you can drive in a day, then you might set the odometer and at zero and drive for the day. And then if you want to see how far you're going to drive in the next day, you could say, where did I stop? And then count from there, or you can reset the odometer to zero and then see how far you drive. What we're doing here in the closing process is resetting the odometer to zero on all income statement accounts, income and expenses. So all we have to do is just reverse whatever's in there, and the difference is going to go to the equity section, which if it was a corporation would be called retained earnings. Now there's also an issue of the draws and investments, noting that in a software like a QuickBooks or a Xero, these do not close out automatically, as do the net income accounts. All the income and expense accounts will close out automatically. If it's in an equity account, it's not going to close out to retained earnings or to owner's equity, however we have set that up. In a book problem, you should close it out, and we would have to manually close everything out. Now, if you don't close out the owner's draws and investments, then that's not really the end of the world. It just means that these accounts are reporting the draws and investments not for the current period, not for the current month or year, but rather for the year to date. They never go to zero unless you zero them out. So that's going to be the idea with those. We're going to leave those as is because our focus is on the income statement. So let's go to the adjusting entries. This is as easy as this. We're just going to say as of, let's say, 2/28. Well, let's just call it closing entries. Is going to be closing entries of, let's say 2/28 closing entries. 2/28 closing entries. So I'm just going to go to the income statement over here. And everything on the income statement needs to be zero. So I'm just going to say this is going to be negative of the one above it. Whatever's in there, I want to do the opposite. And I'm just going to take that whole thing, copy it across. And so now we're just going to do the opposite of every account that's a temporary account, all income statement accounts, in other words. Now, it has to be in balance. So where's it going to go? Okay, paso. What is happening here? It's going to go into the owner's equity, noting that this would be the account that would automatically roll over in like a QuickBooks or a Xero. If it was a corporation, it would be called retained earnings, noting the name retained earnings, indicating that it's the earnings that the corporation, in that case, has earned, has accumulated, but not given out to the owners in the form of dividends, hence retained. We retained them in the company. So this is going to be the negative sum of all of this, which is going to be basically the net income. So this amount, 1324, you'll recall, was the bottom line of the income statement, hopefully, right? It's the bottom line of the income statement. It's net income. So this is the amount that would be shown on a QuickBooks software, for example, in net income in the equity section, trying to let us know how the income statement is tied out to the balance sheet. Now, remember how this is a problem, because if that was shown on the balance sheet, it could be messy if you have a partnership, for example. If you have a partnership, you have 5 partners, let's say, then it's not enough to just say you have one account that's going to be all equity that represents the owner's share of the assets, as opposed to the third-party liability shares, like the bank, of the assets, for example, because you have to further break it down into which owner. There's 5 of them now. So similarly to having like the accounts payable needing a subledger telling you who we owe that money to by vendor, you're going to need in the equity section a list of all of the partners listing out who we owe the money to, because it's not going to be equal. And this, I just want to point this out because a lot of people think that a partnership means it's going to be split evenly, or even that a partnership means 2 partners, like a marriage or something. Marriage is a type of partnership, but we're talking about a corporate partnership, so there could be 100 partners, right? There could be, but there might be more than 2 partners. And you don't always need to split the partnership evenly, because you see how restrictive that would be. You can't always have an even partnership, because people are contributing different things into the partnership. That's why you're bringing up a partner. I'm not bringing in a partner that's exactly like me, because I already have someone exactly like me. Like, I might have some money and someone else might be smart or something. Then I'm going to put in the capital, and they're going to be the smart person that actually like earns money or something. That means that we should split the revenue in some way that coincides to the contributions of the partnership. And the thing about a partnership is you have a bunch of different ways you could do that. So you might split the partnership up differently, which means that this net income needs to then be allocated to the partnership accounts in that case, which is kind of a problem if the QuickBooks file has net income sitting there as a lump sum, because you want to break it out into the partnership accounts, right? So that becomes kind of an issue. If it was a corporation, it's actually a little bit easier for a corporation, because you break out the different ownership potentials of a corporation by breaking the corporation value into equal chunks. And then some owners can own more of those equal chunks, like owning dollars that all have equivalent value, than others. So on the investment side of things, however, remember that if it was a corporation, then the investments would be from the owner. That would be when the company issues the stock, not when you buy the stock on the secondary exchange, but when the company issues the stock, then the owners are giving money to the company, investing in the company for the stock. That's going to be equivalent to an investment in our case, or owner investment for a sole proprietorship. And the draws, you will recall, are us, the owner, taking money out of the business. If that we equate that to a corporation, it would be dividends going out of the business to the owners. Noting, however, that dividends, if you're a corporation, are going to be more of a bureaucratic problem, because you can't, like in a partnership, have each owner taking out a different level of dividends from the corporation. It has to be equal, because that's the point of having stocks. They're all the same, and therefore you're going to have some, board meeting and whatnot and management to figure out the dividends. So I'm not going to close out the draws and the investments. We're going to keep those as the lifetime, draws and investments. So I'll just say 0 here and 0 here. And then let's put zeros across the board, noting that all of the other accounts are what we call permanent accounts. Basically, the balance sheet accounts, or at least the assets and liabilities, are permanent as opposed to temporary. This is also a good point to point out the terminology that often is a problem of these income statement accounts being called temporary, and these two accounts would be temporary as well in a book problem, because they close out periodically when we do the closing process typically. That's different than, say, a clearing account. And a clearing account is going to be something like this undeposited funds, where we put the money into a holding account instead of putting it into the cash account, so that we can then use it to group the money into the checking account in the same way that it will be shown on the bank statement. So that means that this one's going to go up. They both temporary accounts and clearing accounts, therefore, are going to zero out, right? They're being used to go up and then back down to 0. But the clearing account has a specific purpose and isn't really used on like a timing frame, such as the temporary accounts. The temporary accounts go up and then they get zeroed out, but they get zeroed out when the closing process happens. Whereas a clearing account goes up and gets zeroed out, but it gets zeroed out not when the closing process happens necessarily, but rather whenever it served its purpose, right? In this case, whenever we take the money out of it to deposit into the checking account. All right, let's put an underline under this whole dang thing. Underline, home tab, font group, underline. There we go, yo. And let's bring down the balances. So I'm going to say balances need to be brought down. Let's see if we're in balance first. So notice that nothing's happening. Why? Because the income statement is part of equity. It closed out into another equity, which is the owner's equity. And I put the underline in the wrong spot. Get your head in the game. Now you got to fix it. I'm sick of fixing your problems, man. Get it right the first time. Home tab, font group, underline. All right, I'm going to underline it here. All right, I see it now. I see what I did wrong. I'm going to underline the right one this time. All right, and then let's sum this up. Equals the SUM of the prior balance current activity. All the permanent accounts remain the same. We're just going to copy this across formula-wise. But the income statement accounts, those get zeroed out. So now we have a nice fresh start of zeros in the income statement accounts. Now, when we enter our reversing entries here, it's going to look funny because we're going to start off with some income statement accounts that are kind of backwards. Meaning, when I reverse like that invoice transaction, I'm going to start with a sales account that will be negative, and a cost of goods sold account that will be a positive number here, but it'll be like a negative expense, right? They'll be backwards. Because usually these accounts only go one way. They go up. Like if you're driving your car and you're seeing how far you can go in a day. Even if you drive in a circle and you make a U-turn, the odometer still goes up, right? That's the same with all of these accounts. They go up until we close them out, resetting the odometer, unless something funny happens, like the reversing entries that we're going to be entering next time. So that's going to confuse the bookkeeper a little bit, because they're going to be like, what is going on with these like reversing entries? They make the income statement funny looking. And we're like, that's cool. And so we're going to deal with it. So we might have to say, okay, explain why that happened, but it made the data input easier, right? So we'll kind of explain each of the reversing entries, preparing ourselves for explanations to the bookkeeping department, which is part of and the accounting department or whatever, which is part of our job to keep everybody in the loop and on the same, knowing what the other person's doing. Whether you're in the accounting department or the adjusting department, it shouldn't be like, oh, those stupid adjusting people messed up my stuff again. Or in the adjusting department, well, those dang accounting people are mad that I did this or the other thing, right? We try to keep it, each one should respect that the other one is doing a different objective, and we're trying to keep it so each one can do their objective without messing up the other one. It's kind of, that's what I'm thinking. All right. People are going to be mad. I know. You can't make people happy. I know, but we can try to explain it. They're going to get mad at you no matter what you do. Okay. Let's not get defeatist. Let's not get like nihilistic or like, anyway, no need to despair. We'll make it so people understand. Let's put an underline here, home tab, font group, underline. And that looks good.